I teach and share and show people the living benefits of life insurance. Yes, there's a death benefit, but there's so much more to it. It is called life insurance for a reason. We want to use these living benefits to our advantage. And I'm going to show you another way that we do that. I want you to think about this. I'm going to draw these two pools. Okay, think of these as pools of money. On the left, we have the stock market pool of money. And again, these are things like a 401k, an IRA, mutual funds, could be a brokerage account with stocks, bonds. Now, what happens in retirement when you're sitting on that pool of money and that's all you have? In retirement, are you more aggressive with your investing or are you more conservative? You all know the answer to this. You're more conservative. You don't want to take risk because in retirement, it's more about principal preservation. We want to protect what we've earned. So more times than not, people are investing in things that are earning lower returns because they want safety. They want to make sure that if there is a downturn or a crash or a correction, they're not going to lose a ton of money. But here's the other problem. What if you're banking on a certain amount of income in retirement from your stock market portfolio and the market crashes? You still need the same amount of money to live on. But if you take money from a negative stock market portfolio, you now cause double pain to your overall value because you're now taking money out of a negative account. And I'm going to show you what that looks like here in just a minute. Whereas on the right-hand side, if we now look at this as the life insurance portfolio and specifically cash value, because remember the cash value in a whole life insurance policy is guaranteed to grow every year. There is no market volatility. So what we have over here is a guaranteed potential income. Here's what that looks like. The way we want to look at this is we want to take market history from a time when a 12% average rate of return happened. Now, this doesn't happen in the market. This is the S&P 500 from 1970. I'm going to blow this up so you can see it bigger. 1970 to 1994. So I'm taking a 25-year history. But the reason I'm using this is I needed to find some years that showed roughly an average of 12%. Now, although the average is 12, I want you to look through this column of numbers right here. Do you see a 12 anywhere in here? The answer is no. An average rate of return, if you go back and watch some of my prior videos, prior webinars, an average rate of return is completely meaningless. All it is math. It's adding the numbers up, divided by the years, we get this number. But the reason I'm doing this is I want you to see this. If I take a 25-year history, and I put in an earnings rate of 12%, and let's assume in retirement, you have $1 million portfolio. And let's call this age 65. And now you're ready to start taking income. And if you listen to Dave Ramsey or Susie Orman, they'll tell you, hey, you're going to earn 12% in your mutual funds. And so that means that you could take out 10% every year, right? We're coming back to what I shared with you earlier as I drew this out. This left-hand pool of money. Take money out of your stock market investments for retirement income. That's the idea. Well, if we take 10% out, which 10% of $1 million would be $100,000 a year. So I'm going to do minus $100,000. And you're earning 12%, everything's going to be wonderful, right? No problems. Matter of fact, at the age of 89, 25 years later, the account value is still $2 million. You're feeling pretty good. You could spend and keep enjoying that money or give it to your heirs if you pass away. But here's the problem. I'm going back to what I mentioned earlier. This earnings rate column, does the market consistently earn 12% every year? And the answer is no. So as we look at this market history, what I shared with you earlier, that's why I pointed this out. There is no 12 in this column. So what I'm going to do is I'm going to copy and paste these numbers. By the way, look at some of these great returns, 18%, 23%, 22%, 31%. I mean, there's some awesome numbers in here. I'm going to copy and paste these 25 years of history. Now we're going to put these into the real life situation. I'm going to paste those rates right into the earnings rate column. And look what happens. If you continue to pull $100,000 out of the account for your income, look what happens in year 4. The market went down 14%. You pulled out 100 grand, you lost 130,000. That was 230 depleted. Your million portfolio has now been eroded to 776,000. Ouch. And the next year, the account loses 25%. You still need your $100,000 of income to live on, but look, $175,000 of additional losses. What was $1 million just 2 years earlier is now $500,000, and you still got life to live. So if we run this scenario, really seeing what's happening with the market, the ups and downs, the volatility of the market, you get to age 77, 13 years in, you're out of money. You're done. The next year, it's gone. You can't go negative 57,000. There's no more money left. So the way that we insure against this to secure our future is when there's a down market or the year after, if you're suffering those losses, guess what? You don't take money from the stock market account. You don't want to add salt to that wound. You just got hammered with 14% losses or 25% losses. Now you take your $100,000 of income from the life insurance cash value. See, the life insurance cash value is giving you a hedge against market losses. It's that pool of money that's secure, and that way you can potentially never run out of money. And we've seen this used. Okay, this is one more example of a life insurance policy benefit. You can use this as a buffer. Okay, another thing I want to share. You guys remember these when you were a kid? Getting that hall pass, the permission slip? I remember being in elementary school and having a permission slip given to me by a teacher so that as I was walking the halls, if another teacher saw me or the principal, I wouldn't get in trouble. Those are kind of fun experiences to go back and think about. And how did you feel? How did you feel getting a permission slip? It was like awesome. Like, you're like, well, I'm the hero. Yep, I'm cool today. I've got a permission slip. Well, a life insurance policy gives us that same feeling and the same permission. By having a cash value life insurance policy, you have a permission slip to spend and enjoy all the money you make while you're alive, because there will be a death benefit that will come in and replace everything that you've spent. Here's what I mean. We're going to now look at what's called a distribution calculator. This is now you taking money out of a portfolio, perhaps, in retirement. And what does this look like? So what I'm going to use is I'm going to show that in retirement at the age of 70, you've got $1 million. I'm showing this million, everyone, because it's just easy to think about. And if you're following the traditional financial planning advice, you're being told that in retirement, you should live interest only. Only live on the interest, don't touch the principal. It is such a popular delusion. It's such a popular myth. That's what most financial advisors are telling their clients. And they're doing that because they still want to continue to manage your money while you're retired. So all you're spending is your interest. So we're going to show a 4% earning rate here. And one of the reasons why, again, is when you're in retirement, you're going to invest more conservatively. But also there's another rule out there I'm going to share with you called the Monte Carlo rule. And the Monte Carlo rule simply says, well, the old rule used to say that you could spend and enjoy 4% of your retirement income. And when you pass away, which is based on mortality, you would have $1 left to your name. So you see here, this was the old rule. The 4% rule isn't the 4% rule anymore. Now it's about 2.8%. So you see here, if you did spend and enjoy 4% of your portfolio, if you live for 30 years in retirement, you have an 85% chance of success of not running out of money. Now, I don't know about you, but I don't want an 85% chance in retirement of not running out of money. I want a 100% chance that I'm not going to run out of money. I don't want to go back to work, which we see a lot of people doing at 85 and 90. I don't want to do that. Now, I love what I do, so I hope I'm doing something, but you understand my point. I don't want to be forced to have to go back to work. If you're pulling 5% from your portfolio 30 years out, you have a 60% chance of making it. That means 40%. Good luck. New Monte Carlo is you pull 6% of your portfolio out in retirement, you only have a 30% chance of making it 30 years. So the new rule is about 2.8%. We're showing 3 here. If you pull 3% out, 30 years, you have about a 98% chance. 2.8, pretty much you're guaranteed. You should be good to go. So that's one of the reasons I'm using the 4% rule here. And you're going to see me change some of this here in a minute. Okay, I'm trying to be fair about this. But because the traditional financial planning advice is interest only, and we run this for, let's say, 25 years, we'll go age 70 to 95. We see that on $1 million portfolio, that's $40,000 of income a year. But it's in a brokerage account or it's in an IRA. That money's taxable. So we have to pay the tax. Now, this is as if it's in a brokerage account, only paying tax on the gains, no principal, only the gains. So we pay the tax. How do you want to live? 35 grand a year, you're worth $1 million. That's all the income you get. How does that make you feel? Think about that. What you're seeing right here is traditional, typical financial planning advice. Live interest only. But here's the problem. This $1 million that you have over here, it's your money. And you're going to pass away at some point. Well, when you pass away, guess what? That $1 million is going to go to your heirs. It's going to go to your family. It's your life insurance policy. Whether you like it or not, you just spent $1 million for $1 million death benefit. Do you understand that? It's $1 million. It's your cash. And you just paid $1 million for that $1 million death benefit to go to someone else instead of you. So what I say is there's got to be a better way. And that's why we use the permission slip example that I shared a few minutes ago. Having a life insurance policy truly is a permission slip for you to spend and enjoy your money while you're alive. So now let's look at distribution 2. This is age 70 with life insurance. But instead of $1 million, you had to buy some life insurance. You had to spend the money on some life insurance. And so what you did is you ended up purchasing $1 million death benefit to cover the $1 million that you had. And it cost you over time about 10 grand a year for 25 years. So this is now $750,000. And we show an earnings rate of 4%. But here's the difference. Because you know you have $1 million death benefit out there, you can spend and enjoy all of your own money. No guilt. It is your permission slip to enjoy that money while you're alive. So you pay it down. You spend principal and interest. Instead of only getting income of $35,000 on the $1 million, you get income of $44,000, $9,000 more dollars a year. And check this out. The income is going up. Why? Because you're pulling principal and interest from the $750,000, you're paying less tax. You're paying less tax because of principal and interest, where this over here was all interest. Well, what's the net effect? When I click the compare button, because you had this life insurance policy and $750,000 was spent down instead of $1 million, you were able to spend $1.15 million versus $889,000 because you had a life insurance policy as a permission slip. You spent $264,000 more on less money. $750,000 gave you $264,000 more spendable income. Well, what's the net effect? The net effect, I need to pull this up. Here's that $1 million death benefit that you purchased that I said earlier, $10,000 a year, right here, but you only did it for the 25 years. So when we look at that calculator and we run you out to the age of 95, we look at the death benefit at 95, it's a $1.5 million death benefit. Not only did you get to spend and enjoy $264,000 more dollars, you also left a $1.5 million death benefit to your heirs. Not just $1 million over here, $1.5 million. So again, we're talking about the power of life insurance. In the last few minutes that we have, I want to wrap up with this idea. There are ways to use your death benefit while you're alive. I hope I've been really clear about that tonight. Super important. These are living benefits. And I just shared that one with you. A permission slip to spend down your assets. 2, pension maximization. You know, a lot of people in retirement, they get a pension, but they take the option for less income to cover a spouse. It's actually better to get the most pension income you can get and have a life insurance policy to make up the difference, that if you pass away, then your spouse can get more money. So that's another conversation, but pension maximization gives you more income now and a death benefit for heirs. You can also take the dividends from your life insurance policy in cash. You don't have to reinvest those. So in retirement, if you want those dividends coming to you from the life insurance policy, totally possible. How about a reverse mortgage? You know, I like reverse mortgages in most cases because it allows you, one, to free up a payment, or if you have a ton of equity in your house, you can put that equity to work. Well, a lot of people have fear. Well, if I've got a reverse mortgage and now there's going to be, more interest on the back end, or what are my kids going to do if they want the house? Well, guess what? If you have a life insurance death benefit that will never go away, that life insurance death benefit can pay off the reverse mortgage. It's an awesome strategy. And then lastly, you could actually sell your death benefit to a life settlement company. You could sell your death benefit to someone else and cash in while you're alive. So with that said, everyone, thank you for attending the webinar. We've talked about how to secure your future, your family, and leave an amazing legacy. You can do this. If you've liked what you've seen in the webinar and you would like to learn more and find out what's possible, click below to schedule a call with me. You can also send an email. I encourage you to take the next step, find out what's possible for yourself, see your own numbers, and how infinite banking can dramatically impact your life and your financial future.